If I handed you $50 right now, you'd feel a little flicker of happiness. But if I reached into your pocket and quietly took $50 out, you'd probably be thinking about it for the rest of the day. Same amount of money. Completely different reaction. And that gap, that tiny, asymmetrical emotional response, is one of the most powerful forces quietly shaping every financial decision you have ever made in your life. Welcome to Money, the channel where we take the most fascinating ideas in psychology, economics, and human behavior and turn them into stories that actually make sense. If you want to understand why people do what they do with money, and more importantly, why you do what you do, hit subscribe and tap that notification bell. New episodes go up every week, and the stuff we cover here will genuinely change the way you see your everyday decisions. Today we are diving into something called loss aversion. It's a concept that started in a psychology lab in the 1970s, ended up winning a Nobel Prize, and explains everything from why stock markets crash to why you are still paying for a gym membership you haven't used in 3 months. This isn't about being irrational or bad with money. It's about the specific way the human brain is wired, and once you understand it, you will start noticing this invisible force operating in your own life constantly. And you'll never quite make a decision the same way again. Let's go back to 1979. Two psychologists, Daniel Kahneman and Amos Tversky, are running experiments in Jerusalem. These aren't complicated lab setups with machines and electrodes. They're just asking people to make choices. Here's one of the questions they used. Imagine you're offered a guaranteed $500. Or you can flip a coin. Heads you win 1,000, tails you win nothing. Most people take the guaranteed 500, even though the expected value of the gamble is mathematically identical. Fine. People like certainty when things are going well. But now flip the scenario. You owe someone $500, and you have two options. Pay it off right now, guaranteed, or gamble. Flip a coin. Heads you don't have to pay anything at all, tails you owe 1,000. Same math. Same expected value. But now, people become far more willing to take the gamble. Something changed, and it wasn't the numbers. It was the framing. A loss was on the table, and the human brain responds to that in a completely different way. Kahneman and Tversky ran variations of these experiments for years, with hundreds of participants, across different cultures and formats. The results were consistent every single time. And in 1979, they published their findings in a paper called Prospect Theory, which went on to become one of the most cited papers in the entire history of economics. Their core finding was this: losses feel roughly twice as painful as equivalent gains feel good. Losing $50 doesn't just feel bad, it feels about twice as bad as finding $50 feels good. That isn't poetry. That is a measurable, documented psychological ratio. They called it loss aversion, and it sits at the heart of how human beings actually make decisions. Here's what's remarkable. This isn't a weakness that belongs to certain personality types. It doesn't diminish with education or experience or wealth. Neuroscientists later found that when people face potential losses, the amygdala, the part of the brain responsible for fear and threat responses, actually activates. You are not just calculating. You are having a fear response. Loss aversion is operating at the neurological level, below the threshold of rational thought. When you think about our evolutionary history, this makes complete sense. Picture one of your ancestors 50,000 years ago. They have just enough food stored to survive the week. Someone offers them a bet. Flip a stone. Heads, they double their food supply. Tails, they lose everything they have. Even if the math is perfectly fair, losing the bet could mean starvation. Death, possibly. The downside is catastrophic in a way the upside simply isn't. So the brains that treated potential losses as high-priority threats, brains that went into overdrive, at the possibility of losing resources were the brains whose owners survived long enough to pass on their genes. Loss aversion wasn't a design flaw. It was a life-saving feature. We just carry that ancient wiring into environments it was never built for, like financial markets, online shopping carts, and salary negotiations. One of the most striking demonstrations of loss aversion in everyday life is something called the endowment effect. The moment you own something, your brain assigns it more value than it would if you were about to buy it. In one of the most famous experiments, some participants were given a coffee mug and asked how much they'd sell it for. Others who didn't have the mug were asked how much they'd pay for the same one. The sellers consistently named prices about double what the buyers were willing to offer. Same mug. Nobody had even used it. But giving it up now felt like a loss, and that made it feel precious in a way buying it simply didn't. This is why cleaning out your closet is weirdly emotional. Why selling a home you've lived in feels like grief even when the offer is generous. Why breaking up is hard even when you know it's the right decision. Why it's so difficult to cut a losing stock from your portfolio, or cancel a subscription you barely use. Your brain isn't registering these moments as rational trade-offs. It's registering them as losses. And that signal is loud and persistent and much older than language. In investing, loss aversion creates a well-documented pattern researchers call the disposition effect. Investors consistently sell their winning stocks too early and hold their losing stocks too long. Selling a winner locks in a gain, pleasant but not urgent. Your brain isn't panicking. But selling a loser means actually realizing the loss, acknowledging you were wrong, and absorbing the pain. So instead, people hold on. They tell themselves the stock will bounce back. They average down. They wait. Meanwhile, weeks become months, and the hole gets deeper. And this isn't just something that affects people who are new to investing. Professional fund managers show the disposition effect. Experienced traders show it. In one study, professional golfers were found to putt more accurately when saving par than when going for birdie. A par putt avoids a bogey, a loss. A birdie putt is a potential gain. The strokes are mechanically identical, played on the same green, by the same skilled athlete. But the threat of loss sharpened their focus in ways the promise of a gain simply didn't. Loss aversion does not care how experienced or sophisticated you are. It even shapes behavior in workplaces in ways most people never consciously register. Research shows that employees work harder and perform better when they've been told they could lose a bonus they already have than when they're told they might earn the same bonus if they perform well. Frame the reward as something they could lose, and motivation spikes. Frame it as something they could gain, and the effect is measurably weaker. The same asymmetry runs through salary negotiations. People tend to fight harder to avoid a pay cut than to push for an equivalent raise. Loss aversion isn't just a personal finance issue. It's a feature of human motivation running through virtually every domain of life. Companies have understood this for decades, and modern marketing is quietly saturated with it. When you see limited time only 2 left in stock, your card is about to expire, or don't miss out, that is not neutral information. That is a precisely engineered trigger. A calculated activation of your ancient threat detection system. The product didn't get more valuable. The urgency isn't always real. But your brain hears loss, and it responds before you even realize it's happening. Free trials that auto-convert to paid subscriptions are a perfect example of the endowment effect being exploited. After 30 days with something, canceling it doesn't feel like stopping a purchase. It feels like giving something up. Insurance products lead with worst-case catastrophic scenarios because fear of losing what you have sells far more policies than the abstract idea of protection. Even price anchoring, the crossed-out original price sitting above the sale price, frames your decision as avoiding paying more rather than gaining something you actually need. In negotiations, This dynamic has been intuitively understood by skilled dealmakers for centuries. You stand to lose this opportunity lands with more psychological weight than you stand to gain this opportunity. Politicians frame policy around what voters will lose without it. Sales teams are trained to emphasize risk over reward. Loss aversion makes the threat of losing more immediately motivating than the promise of winning, and anyone who wants something from you knows this, whether they know the academic name for it or not. So what do you actually do with all of this? The honest answer is that knowing about loss aversion doesn't make you immune. Kahneman himself, who won the Nobel Prize in Economics in 2002 for this work, has openly said that awareness of these biases doesn't stop him from experiencing them. You will still feel the sting of losses more sharply than the joy of equivalent gains. But awareness gives you something genuinely useful, a pause. A moment to recognize what's happening before you act. When you feel sudden urgency to do something in order to avoid losing, slow down. When someone is using loss-framed language to pressure you, flip it deliberately. Ask yourself, what do I actually gain by doing this? What do I actually lose if I don't? Is the threat real, or is it manufactured? Pre-commit to financial rules when you're calm, before fear has a chance to enter the picture, so that when markets drop or a flash sale looms, you're not making decisions from a survival instinct designed for a world that no longer exists. The deeper truth here is this: your brain is not always trying to help you get ahead. Sometimes it is desperately trying to protect what you already have, even when protecting it is exactly the wrong move. Knowing that the pain of potential loss is about twice as loud as it should be is one of the most practically valuable things you can take from behavioral science. It won't make you perfect, but it might make you a little bit harder to manipulate by the market, by advertisers, and by your own ancient wiring. Here's what I want to leave you with. Think about one decision you've been avoiding, financial or otherwise. Ask yourself honestly, is steering clear of it actually the right call, or is your brain treating a manageable setback like a survival emergency it isn't? Drop your answer in the comments. I read every single one, and those conversations are genuinely my favorite part of making this. If this shifted something for you, a like makes a real difference. It tells the algorithm that actual humans found this worth watching, and that helps this channel keep growing. And if you want to keep going down this rabbit hole, next time we are going to look at another invisible psychological force that quietly shapes financial behavior, one that's closely related to loss aversion, but works in a way that's even more surprising. You're going to want to be there. I'll see you then.